Let us see the next question. You are interested in purchasing some equity stock of RK Ltd. So you are considering to purchase the equity share of a company called RK Ltd. The company has three divisions operating in different industries. So the information is given that say this company has the three divisions and operating in the different line of the business. Division A captures 10% of its industry sales, which is forecasted to be 50 crore for the industry. So Division A has the market share of 10% and the industry sales is 50 crore. Division B, Division C captures 30% and 2% of their respective industry sales. So Division B is having 30% and Division C is having the proportion of 2% only, which are expected to be 20 crore and 8.5 crore respectively. So again the industry sales is provided to us, and along with that, so what is the proportion of the division is also given to us. Division A traditionally had 5% net income margin. So the net profit ratio is 5%. Whereas B and C had 8% and 10% income margin respectively. So B had NP ratio of 8% and C has 10%. RK Limited has 3 lakh equity shares outstanding which sales at 250. So the current price is provided as 250 and the number of equity shares are given as 3 lakhs. The company has not paid dividend since it started the business 10 years ago. So far, there is no payment of the equity dividend by the company. However, from the market sources you come to know, the RK Limited will start paying dividend in 3 years' time. And so the payout ratio is 30%. So it is anticipated that the company will pay 30% of the earning in form of dividend. And it will be started from the 3rd year onwards. Expecting this dividend, you would like to hold the stock for 5 years. By analyzing the past financial statements, you have determined that RK Limited's required rate of return is 18%, that is discounting rate is given. Price earning ratio is 10 times for the next year and ending price earning ratio of 20 at the end of the 5th year are appropriate. Required. Would you purchase RK Limited's equity share at this time based on very important word that they have used is on your 1 year forecast. Then second part of the question is given that we will read later on. Ignore taxation, present value factors are given below. So for 18% year 1 to year 5 factors have been given to us. Everybody is requested to go through the question, then we'll discuss how to do it. Please go through the question. Let us understand, students, that say how we are required to make the calculation of answer. First of all, we have been provided with the sales information. We have been provided with the net profit information. So based on that, we'll make the calculation of the earning. Number of shares are given and based on that, the EPS will be calculated. So let us start making the calculation of first of all earning per share. Of course, that is going to be helpful to us for making calculation of the answer. Written answer. Working note number 1. Calculation of earning per share. Let us see that say how we will make the calculation. It is division. Then we'll make the calculation of the profit. The same will be divided with the number of shares. As far as the division A is concerned, we can see that the information is given to us like this, that the sales of the industry is given to us 50 crore. Then we have been given that so the division A captures sales of 10%. And lastly, we have been provided with the information that so the profit ratio is 5%. So taking this three information into account, we will make the calculation of answer. So we start something like this. Listen carefully. It is 50 crore multiplied with 10%. That is a share of A Limited multiplied with 5%. That is the way we are required to make the calculation of answer. So here 50 crore into 10%, 5 crore into 5%. That is 0.25 crore. That comes to an amount of 25 lakhs. For division B, we will make the similar calculation, friends. The sales is provided for division B an amount of rupees 20 crore. Then we have been provided with the information that its share is 30% and the profit is 8%. So it is an amount of 20 crore multiplying with share is 30% into net profit margin of 8%. So 20 crore into 30%, that comes to 6 crore into 8%, that is 0.48 crore. That comes to an amount of 48 lakhs. Similarly for C, it will be calculated. Industry sales is provided to us as 8.5 crore. Share of C Limited is provided as 2%. And the net income margin is 10%. So 8.5, 2 and 10. 8.5 crore into 2% into 10%. That comes to an amount of 1,70,000. Based on that, so we'll make the calculation of the total. 1,70,000 plus 48 lakhs plus 25 lakhs. That comes to 74,70,000. Divided by the number of equity shares, that is provided as 3 lakhs. This will give us earning per share 24.9. Please write down answer. Now friends, over here, language of the question speaks very clearly. Let's say for the next 3 years, there is no dividend to be paid. Further, the question says that the price earning ratio is right now 10 times. And so it is going to be 10 times for the next year as well. Like that information is given. Oh, that is the next year price earning ratio is given 10 times. The discounting rate is given 18%. Listen carefully what I am going to speak. We can say something like this. The first part of the question says that if at all you are going to hold equity share for 1 year, then in that case should you purchase the share or not? That is a question. I repeat the language of the question. The question says that would you purchase the equity share of the company considering that you are going to hold the equity share for 1 year? That is a question. Let us have understanding that how we will make the calculation of answer over here. Students are requested to pay attention. Calculation of P0. How we will make the calculation of P0? We understand that say P0 is equal to D1 plus P1 divided by 1 plus K. In a way that say whatever is the price of equity share and whatever is the dividend per share, that will be discounted in present value term to make the calculation of the current price. Now the dividend income is of course going to be 0. Discounting factor is given to us in the question as 18%. Now the only thing which is required to be computed is the market price of the equity share at the end of the year. So in order to make the calculation of the P0, first of all we are required to make the calculation of the price of equity share at the end of the year. So we will start working like this. Working note number 1, calculation of MPS at the end of year 1. We understand that so the price earning ratio is equal to MPS upon EPS. So as far as MPS is concerned, it is EPS into price earning ratio. What is earning per share, friends? We already have found it 24.9. Multiplied with the price earning ratio which is given to us in the example. It is provided to us as 10 times. We'll make the calculation of MPS and based on that the price will be calculated. That is the current year price. Please write on this first working note and then we'll do the subsequent working. So here it is rupees 249. Then calculation of P0. Year 1. Dividend per share is 0. Market price of the share is 249. Net cash flow 249. Discounting at 18%. And importantly, friends, we have been provided with the factor. So please do not use your own discounting factor when they have provided the discounting factor information. Present value of the future cash flow is P0. So here $249 into 0.847, 210.903. That is the way the P0 can be calculated. Friends, we have been provided with the information that the current market price of the equity share is 250. So of course, the price that we are ready to pay is maximum 210 and the current price is 250. So the security is not worth purchasing. Please write an answer. Investor is advised not to purchase the security because actual price is more than equilibrium price, or we can say that intrinsic value. In bracket I am writing 250 exceeds 210.90. Please write an answer. Second part of the question. expect earning to grow at the rate of 15% continuously, how much are you willing to pay for the stock of RK Limited? That is the question. So now the growth rate information is added by them, and we are required to take into account this information now. And based on that, we are required to decide that whether it is worth purchasing the stock or not. That is, what is the equilibrium price of the security. So second part of the question, in that we are required to take into account the information about the growth rate, and of course we will apply the dividend discount model approach for the purpose of calculation of answer. We understand that the question is providing the information that company will start paying the dividend from the third year onwards. For the third year, fourth year and fifth year, we will make the computation of the dividend income that investor is going to receive. At the end of the fifth year, we'll compute the P5. Because we can see that the question is providing very clearly that expecting this dividend, you would like to hold the stock for 5 years. So specifically they have provided that you are going to hold the security for 5 years. So year 1 to year 5 will compute the dividend, will compute the P5, and then we'll make the calculation of the P0. Again, whatever the P0 that we have, that will be compared with the current price of 250 in order to decide whether to buy the security or not. Please write an answer. Second part of the question, in that write down first point. Over here, we will apply dividend discount model approach for decision making. Full stop. Second point, we will compute present value of dividend and present value of price for the purpose of decision making. Full stop. Working note number 1, calculation of dividend per share year 1 to year 6. We'll make the calculation of the dividend per share from end of year 1 to end of year 6. Why? Because the 6th year dividend is going to be helpful to us for making calculation of P5. So first year dividend per share would be 0. Second year dividend per share would be 0. Third year dividend per share would be there. We understand it is 24.90 into 1.15 raised to 3. Dear students, 24.90 is provided to us as the dividend per share of year 0. So that amount will grow at the rate of 15% for 3 years. Why? Because the earning growth is provided to us as 15%. So this is the earning of the third year. The question further provides that the company will have the dividend payout ratio of that is 30%. So into 0.3. That's it. Fourth year, fifth year and 6th year. We understand it's at 24.9 into 1.15 into 1.15 into 1.15. That comes to 36.87. In bracket I am writing 37.87 into 0.3. That comes to 11 rupee 36 paise. That is what we understand is the dividend per share for the third year. फोर्थ ईयर का इनका क्या होगा 11.36 into 1.15 raised to 1. 13.06. 13.06 into 1.15 raised to 1 once again. 15.02. 17.27. Now based on this we'll make the calculation of P5. D6 divided by K minus T. Sixth year dividend is 17.27. Cost of equity is 18%. Less growth rate is 15%. So 17.27 divided by 3%. 575.67. Then we'll compute P0. Next. First year, second year, third year, fourth year, fifth year. We'll mention the cash flow. First and second year it is 0. Third year it is 11.36. Fourth year it is 13.06. Fifth year it is 15.02 plus 575.67. That is 590.69. Now this is discounted at the rate of 18%. Based on that, so we'll compute the present value. 847,718. 609,516. 437. There is no present value. 11.36 into 0.609. That comes to 6 rupee 92 paise. 13.06 into 0.516. So 6 rupees 74 paise. Then 590.69 into 0.437. So 258.13. Then we'll compute the P0. So 6.92 plus 6.74 plus 258.13, that comes to 271.79. Right on answer. So what is the conclusion, whether we should buy or not? So please write down answer. Conclusion: investor should purchase the security because actual price is less than equilibrium price. In bracket write down 250 is less than 271.79.